The Great War is one of the most significant events in world history. It hastened the fall of empires and thrust new powers onto the world stage. It was also massively expensive and was an enormous strain on the world's financial system. Germany, France, and Britain all took their currencies off the gold standard right at the outbreak of the war. After the armistice, they tried to revive the system, but each had a very different experience with that, as we'll see. Despite the benefits the international gold standard brought to world trade, this system was destroyed during the First World War and would never fully recover. Gold standard mythology would have you believe that it lasted for countless millennia. The reality is somewhat different. The truth is that gold isn't special. It's not the most important or the most common form of money throughout history. So when we talk about the gold standard, we don't mean a system in which gold is used as money by some of the people, some of the time. What we're talking about is a system in which every major country used gold, and gold alone, as the basis for their currencies. That system didn't last very long at all. But during its short run, this system had enormous benefits for world trade and was a stabilizing influence on the world's economy. It removed one of the major risk factors for merchants trading between countries, which was the exchange rate. With the gold standard, every country's currency was convertible into gold at stable exchange rates. This made turning a profit from international trade so much easier. It also stabilized the world's economy and bound the economic fate of nations together. Now, gold isn't necessary as a stabilizing device, but there are benefits if you can get every country in the world to agree to certain ground rules when it comes to their currencies. And the simplicity of gold made it easy for world powers to agree. It was a convenient benchmark that served as the basis for a unified world financial system, at least while it lasted. The international gold standard began in 1871 with its adoption by the new country of Germany, who was following Britain's lead. Every major country would eventually follow suit. Even the long-resisting US officially adopted the gold standard in 1900, pretty close to the end of the system. For every major country but the US, the gold standard completely collapsed at the start of World War I in 1914. That year, financial experts in the United States thought they should also go off the standard. That's because European countries, most of all Britain, had been heavily investing in the US for over a century. They had vast reserves of US stocks and other securities, as much as $6 billion worth. If these stocks were sold and the proceeds exchanged for gold, the Federal Reserve had only about $200 million worth of gold in 1914. They could run out in weeks. But the experts were wrong. That never happened. Well, yes, US stocks did plunge at the outbreak of the war, enough to prompt the closing of the New York Stock Exchange, and some investors certainly asked for their gold back. But by 1915, it became clear that the net flow of gold was sharply into the US, not out. That's because Europe desperately needed food, ships, guns, and ammunition. Lots of it. And the US had it for sale when no one else did. European gold flooded in, and by 1918, at the end of the war, U.S. gold reserves stood at $2.9 billion, or about 1/3 of the monetary gold of the entire world. That's perhaps more gold than any other nation has ever possessed in world history. And I guess US bankers had matured since the free banking era, because this gold was generally kept in their vaults and it wasn't used to boost the money supply. That's a good thing, because prices would have gone through the roof. Prices were increasing at a pretty rapid pace without any extra help. Unemployment in the US had mostly vanished because there was so much work to do. We were helping to feed and arm the whole world. Being neutral, the US could sell to both sides, although most of these supplies went to Britain and the Allies because they held naval superiority. Yet, after entering the war, the United States had revenue problems of their own. Congress raised income tax rates to help pay war expenses, but that wasn't enough. They ended up borrowing heavily from the public as patriotic Americans bought war bonds in large numbers. Unfortunately, the war bond program was handled very poorly. Americans were actually encouraged to borrow and buy these Liberty loans instead of paying for them out of their income. Since the whole point here is to reduce people's buying power in the same way that taxes do, borrowing to buy bonds defeats the whole purpose of the program. They could have just printed the money. These bonds didn't reduce inflation during the war much at all. Prices in the US doubled during the war because the bond program was mismanaged and because Congress was unwilling to raise taxes as high as was needed. Of course, things were much worse in Europe. Britain and Germany enacted rationing and price controls and managed to limit their inflation to just a little higher than in the US, despite being much more intensely involved in the war. But most of the fighting was in France, which was completely devastated. The French were reluctant to raise taxes or enact price controls. They suffered for it with much higher inflation. At the end of World War I, every European country was in more or less the same situation as the US was after the Civil War. They were off the gold standard, which was very uncomfortable for financial conservatives. They assumed they'd be going back to it soon, but they had too much paper in circulation and too little gold to redeem it. It's a problem that was not easily solved. Different countries went about it in different ways, with very different results.
A return to an effective gold standard has long been the settled and declared policy of this country. No political party, no previous holder of the office of Chancellor of the Exchequer has challenged, or so far as I'm aware is now challenging, the principle of a reversion to the gold standard in international affairs at the earliest possible moment. We have, therefore, decided that a general license would be given to the Bank of England for the export of gold bullion from today. We thus resume our international position as a gold standard country.
Winston Churchill, as Chancellor of the Exchequer, made the decision to return Britain rapidly back to the gold standard in April of 1925. With a few $100 million worth of gold loaned from the Federal Reserve Bank of New York and from the Bank of J.P. Morgan, Britain thought they had enough gold to defend the pound. But there was no way British goods would be competitive in global markets with the pound as strong as Churchill wanted it to be. This meant he was condemning his country to a painful period of deflation. Coal miners, in particular, were asked to pay the price for returning Britain to its preeminent position as a gold standard country at the pre-war exchange rate. Due to competition from Germany and the US, the British coal mining industry had had serious issues for years, and mine owners had been cutting miners' pay regularly. Going back on the gold standard was another serious blow to this industry. Just like that, British coal went from barely competitive on international markets to massively overpriced. Or that would have happened if the government didn't subsidize the industry. But in 1926, the government wanted to remove those subsidies. So they actually recommended that miners' wages be cut again. This time by a massive 13.5%. The Miners' Federation disagreed, and they went on strike. Their strike was supported by the Trades Union Congress, or TUC, a much larger organization. This eventually led to a general strike in Britain, with 1.7 million workers hitting the streets in solidarity. But after just a week, the British courts declared that the TUC could be sued for damages if any property was destroyed. Now, the protest had been remarkably peaceful, but TUC leadership just didn't have the stomach to continue after that ruling, and they called off the general strike. The Miners' Federation continued striking, alone, for several more months, but their cause was doomed. Many lost their jobs permanently, and those returning to work were stuck with lower wages and longer working hours. In fact, the whole of Britain had to deal with a depressed economy for years after. That was the price of Churchill's decision. But yes, he did succeed in his glorious return to the gold standard, for at least 6 more years. In 1931, during the Great Depression, the Bank of England was forced to go off the gold standard again, this time for good. Churchill's attempt to reclaim his country's past financial glory is now widely regarded as a massive mistake that caused nothing but easily avoidable suffering. France suffered horribly during the war, with so much of the fighting taking place there. The French economy was completely destroyed. 10% of the population was wounded, and parts of the country were deeply cratered and littered with unexploded bombs. Of course, they blamed Germany for the destruction. Also, the French could not forget the time when Germany made them pay the cost of the Franco-Prussian War of 1870, which France lost. This time, Germany lost, so it only seemed fair that they be forced to pay French reconstruction expenses. With all the damage, you'd think that France would have recovered more slowly after the war than Britain, for example. But since the French assumed that Germany would ultimately be the one paying, they had no problem borrowing whatever funds they needed to rebuild as quickly as possible. Which they did. The French economy rebounded at an unbelievable pace. For example, by 1929, French steel production was double their pre-war capacity. Now, all this borrowing did cause their currency to depreciate. But unlike the British, the French didn't seem to mind a weak currency. It caused French exports to boom, and that caused gold to flood into the country. By 1928, they were wealthy enough to return to the gold standard easily, no deflation required. Of course, the downside to this kind of growth is inflation, and the French got a huge dose of it. By 1926, prices there were 8.5 times the pre-war level. That's a problem. But still, I'll take the French post-war experience over the British one any day of the week. Germany did eventually end up paying its war debt to France. The final payment was made in the year 2010. Since it took so long, Germany wasn't much of a help during French Reconstruction. But the burden of the payments they did make during the 20s was harmful to the German economy at the time, which of course had also suffered greatly during the war. In his book, The Economic Consequences of the Peace, economist John Maynard Keynes argued that war reparations demands by France and other Allied powers were completely unreasonable and unpayable for Germany. But modern scholarship doesn't confirm that view. The current thinking is that Germany could have paid the reparations in a reasonable time frame, but this would have required punishing taxation and deep cuts to government spending. Obviously, no German wanted taxes raised that high, especially not for the purpose of paying off a war debt they thought was unjust. So, politicians didn't raise taxes as high as they needed to. And even so, tax evasion was rampant, especially among the wealthy, many of whom had no love for the new Weimar Republic. During these years in Germany, there were many strikes, uprisings, and rebellions, which didn't help their economic situation at all. Political and social strife in post-war Germany was matched in the financial sphere with an inflationary firestorm. During the war, Germany's inflation was high but manageable, with prices doubling by 1918. But by mid-1921, prices had risen to 14 times higher than before the war. By the beginning of 1922, it was 35 times. And by the end of 1922, I imagine that any Germans who still had confidence in their government must have given up hope as prices rose to nearly 1,500 times the pre-war level. And the next year, the situation just continued to deteriorate as French forces moved to occupy the heavily industrialized Ruhr Valley, demanding that Germany resume reparations payments as scheduled. The costs of resisting this occupation added fuel to the fire, and prices exploded completely out of control. In his book, Money, Whence It Came, Where It Went, John Kenneth Galbraith describes the German experience with hyperinflation. In the ensuing weeks, every trite comment ever made concerning inflation was made real. Men and women rushed to spend their wages, if possible, within minutes of receiving them. Notes were trundled to stores in wheelbarrows or baby carriages. In Germany that autumn, there was resort to virtually every press that was capable of printing money. Notes were in literal fact churned out. Galbraith also shares a story that was printed in the New York Times about a restaurant goer in Berlin. This hungry man, quote, flourished a dollar bill and asked for all the dinner it would buy. He was amply provided. And, as he was about to leave, the waiter arrived with another plate of soup and another entree and bowed politely. "The dollar has gone up again, sir." By the end of 1923, prices in Germany had reached 1.4 trillion times the pre-war level. And that's why on November 20th, 1923, the old Reichsmark was retired. It was replaced by the Rentenmark at the exchange rate of 1,000,000,000 to 1. And Germans must have had confidence in the new currency because suddenly, as if by magic, the grip of inflation was broken. After a short recession in subsequent months, Germany was financially stable again and back on her feet. It's often been speculated that German post-war inflation was a catalyst for the rise of Hitler and the Nazi Party. Certainly, hyperinflation is a traumatizing event for everyone forced to endure it. But it had almost nothing to do with the rise of fascism in Germany. Hitler didn't become chancellor in the 20s, but in 1933, during the Great Depression. The global depression, combined with domestic mismanagement, caused more than a third of the German workforce to be unemployed by 1932. Hitler took power the next year, after almost a decade with stable prices. Back in the US, things were going pretty well in the Roaring '20s. Bank vaults are full to the brim with gold, and the future looks incredibly bright. US bankers showed amazing restraint during the war when they locked all that gold away, but now they're starting to issue currency backed by it. And Wall Street is loving it. Stocks are booming, and with the Federal Reserve backing the financial system, well, things are going to be different this time. I have a feeling. Nothing could burst this bubble. It's the new normal. Right?